So yeah, this month we have some sort of big transactions to report on the secondary side. And we've always said that secondaries happen in two streams. There's classic secondaries of a incoming investor, usually primary round being accompanied by some portion of secondary. So what it essentially suggests is that the company is looking to raise capital, someone is really interested in buying into it, and they have excessive demand. Company only wants a finite amount of money and a finite amount of dilution. They don't want to get over diluted. And so they essentially pass on the extra as an offer to buy out somebody on the cap table, and the founder routes it and checks with the cap table. So, at this juncture, especially in our funds 1 and 2 vintages, Blume, for example, is in a position where we need to show something. It's been close to end of life in all of those extension vehicles in Fund 1, opportunity funds, and in Fund 2 as well, which was a 2015 vintage fund. So we're reaching almost 10 years, another 6 to 9 months. So basically, we have been anyways looking to see how we can exit. And I have an example for you today in our portfolio, which has been a welcome relief and a nice DPI generator for us in Fund 2. And then the second track, which we emphasized is path-breaking development for India, is prior to the COVID era, you saw very little sort of what are called GP-managed secondary portfolios. So basically, there's buyers who are interested in what are called strip sales of portfolios. So if I have a portfolio, somebody doesn't want to buy the entire portfolio, neither do they want to buy a single asset. They think it's too risky. So they actually want a portfolio of companies that they want to buy. So they either buy a few positions entirely, or they buy a proportion of a few companies in the portfolio. All these are variants of secondary portfolio transactions. Within what I just said, there are two types of deals again. Occasionally, the person buying will say, let me buy out the entire portfolio and I will manage it. So we've seen that happen. It has happened when NEA was leaving the country and the firm was rebranded to Mega Delta, and TPG NewQuest helped acquire that entire portfolio. It happened when the Avatar guys were spinning out of Northwest with a SaaS portfolio, and Harbor West helped finance that entire secondary, and the Avatar guys continue to manage it. It happened very long ago when Alok Vittal, who runs a startup right now, but used to run Canaan Partners, and Canaan wanted to get out of the country, and JP Morgan actually bought it and ran the residual portfolio. So those are outright sales of portfolios, which a big secondary buyer takes on. In the case of Avatar, actually, and Mega Delta, the fund continued to be managed by the existing managers. So the brand might have left, but the management team rebranded themselves and continued to manage the assets to exit. So which is what Blume did with our Fund 1 assets. Fund 1X and Fund 1Y were actually variants of this. Interestingly, for all the talk that this only happens in these two situations, we are seeing a surge of these right now in private equity, which is a new thing in India. And we saw one big transaction reported a few months ago where Chris Capital was doing a large single asset continuity vehicle in managing NSE position. And this month we got news, I think it was concluded some time ago, but the news or more details came out from Multiples, which is one of India's largest homegrown private equity firms, and also from Eight Roads, which is actually the old Fidelity group. And Eight Roads has also announced that they've actually done a secondary transaction. I don't know whether it's managed or not, but the Multiples one seems to be a managed one because it's been called a continuity vehicle, much like the ones that Blume did. Now I'm going to talk about two what are called portfolio secondaries, right? So not one asset, but a bunch of assets get sold. From what little we know, 3 companies were sold by Eight Roads for an aggregate of $50 million. Now, we don't know what percentage of those positions were sold and whether they're managed or not. But basically, it was bought by a secondaries firm headquartered in Hong Kong called TR Capital. We've had many discussions with them, no luck yet in finding a portfolio that they wanted to buy from us. But clearly, they liked this 3-company portfolio. So from what we know, MoEngage, Shadowfax, Whatfix. And this is something I've been telling a lot of folks in the last 2 years. A lot of LPs who say, where will India's liquidity come from? And I've been insisting that most of this liquidity, even if it's in the form of secondaries, will actually come from companies that are on a path to profitability or path to IPO. And Spinny was a great example in our portfolio. Why is Axelius buying into it? Because they anticipate that this company can get to profitability and IPO in 2 to 3 years. So that's when the demand is spiking up in secondaries. If that's not visible, we are not seeing secondaries. So the Eight Roads portfolio is a fantastic example of this. MoEngage is potentially a company that's profitable, $100+ million of ARR, from what I hear, growing into US and other markets, and supposedly has interest in either large majority-owned sort of control transaction from a financial investor or a strategic or an IPO. So all their paths are open. So they become very exciting and interesting for a new buyer because they can anticipate a liquidity event in 3 years. Shadowfax in the news literally as I'm speaking, filing for a 2,500 crore IPO confidential. So essentially it's a pre-IPO chunk that's being sold. So you would ask, why can't Eight Roads sell that directly? Guys, this is where you need to understand how secondary portfolios work. If you strip out one of the crown jewels, the other two don't look as attractive. It's the portfolio and the bouquet which looks attractive, not any single asset at any point in time. So if you sell out one of those, the other two might look weaker. So the buyer wants a portfolio. They don't want a single asset. There'll be 5 people who want the single asset, but you have to weigh the balance of what gives you more liquidity at a point in time. In this case, Eight Roads made a call that if I sell only Shadowfax, maybe I'll only make 20 million. But it'll be very difficult to sell MoEngage and Whatfix without packaging them. So that's the key. Whatfix, of course, has been growing very well, has been generating secondary outcomes for Stellaris and other investors. So it's not surprising that Eight Roads would have found an easy price point and a buyer for that as well. So all three got clubbed in. You can clearly see that this is a B2B, a software strong, a SaaS strong portfolio. Clearly, that is the house view at TR that this looks like a attractive buy, a good value buy in those kind of companies, and that's how the deal must have happened. So I'm speculating. Of course, these are confidential deals. You can only report what's in the newspapers. But being in those shoes and trying to package secondaries, I think I have a very good sense of how this will play out. Multiples, run by Renuka, Ramnath, and Dean, one of India's leading private equity firms. $430 million continuation fund. One of the largest portfolio transactions in India to date. The continuation fund raised capital to acquire interest in 3 companies, just 3 companies, right? And this was Vastu Housing Finance, Quantify, AI and digital engineering solutions provider, and a company called APAC Financial Services. It's a financial services platform nationwide from what we know. And Vastu, of course, is a housing finance, affordable housing finance company. So clearly, again, companies which are close to profitability or profitable already, I'm guessing. I don't know enough about the companies. Probably path to IPO, and Multiples wants to ride the upside and has gotten a bunch of investors who believe in it. And these are like really solid global names, but also very active in Asia as secondary buyers. So when you piece something like $430 million, you need a handful of people who can write $150 million checks. And from what little we know, I think there are just 4 buyers from what the press reports. Harbour West, Hamilton Bain, LGT, TPG Newquest. All large secondary specialists based in Hong Kong or Singapore. My guess is nobody has played less than 75 or 100 million here. The biggest guy is probably 150, and they've pieced together this $430 million fund. Usually the economics tend to be tighter in these continuation funds, but why would Multiples complain? Just like why would we complain if we build a continuation fund and we can ride it for a few more years? When you see that there's significant upside, there's 20+% IRR left in these assets, and they look like sure shots. These are great ideas of continuing to generate value for a new set of LPs, for your old set of LPs, and for yourself as the manager. Yeah, exciting month on secondaries, thanks to these funds which have disclosed some of this information. Otherwise, it's very difficult to get this information. But these have been in the press, so we thought we should cover the 2 continuity vehicles. And we are delighted with our own exit, thanks to Neeraj and the team at Spinny, working tirelessly for almost a decade, building a fantastic brand, fantastic platform. We are happy to keep riding it, hopefully into the IPO. But we needed some liquidity and getting close to half of our stake out through that secondary that I mentioned. So that wraps up our secondaries piece, which hasn't been as exciting as this ever before. But hopefully every month we'll have similar news. It's an exciting market. And as more and more companies are going to IPOs, we are beginning to see the IPO path-led secondaries picking up momentum. Thank you.